It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, smartest guy in the room, the guy that you'd want to have as Daddy Warbucks if you were a small orphan. It's Mr. Michael Becker. Michael, how are you?
Paul, doing good. How are you?
I'm doing great in these incredibly hot days here in the Texas area. Michael, how come we didn't move to California and for both of us to do business in California? Why didn't we do that?
For me, taxes probably be the biggest reason. So taxes and cost of living for sure.
And probably because the great state of Texas with multifamily, with tenants. I like the phrase that's been kicked around, and I think I've heard you say that if you don't pay, you don't stay when it comes to being in some of these apartments. That's not the way it is in many different locations, whether you're in Portland or Chicago or New York City or some areas of Denver and all of the state of California. So I think that's probably the better reason why you don't move out to the cool, nice tropical island areas of Southern California. But we have to suffer this through this hot weather, so we continue to stay here. Michael, how's business these days? Multifamily still thumbs up?
Yeah, everything's as we've been talking about for weeks in, weeks out. I feel like a broken record. Everything's super white hot. I mean, it's getting a little frustrating just from operationally. Everything's great from owner's perspective, but trying to buy deals is getting a little frustrating. We've been bridesmaids on, several deals here in the recent past as we're trying to, get another deal put together. So I think I'm the backup offer on 4 or 5 deals in a row now. So if something happens with the first guy falling down, I'm there to hopefully pick up the pieces, but it's been 4 or 5 deals in a row. And we're trying to just chase the deals that we think make sense or close to making sense. So it's really, amazing to see the price acceleration in 2022 and 2021. We've seen in, the first or whatever we're in August here. So we've had 7 months of the year completed, and, the price acceleration has been, stunning to kind of see where things were, a year ago to where they are today.
Being the bridesmaid, does that mean that when somebody opens your closet up that they see a bunch of different color dresses in your closet there, Michael?
It's what it feels like right now. So it whole lot of work and not a lot of results. So it's kind of frustrating, but I mean, it's part of the process, and we've been there, done that. And every time you get frustrated that you're missing out on this or that, you kind of do more and more work and put more pressure out there, and all of a sudden, getting 2 deals that make sense instead of the one, just because you're working a little extra hard and without the results along the way. But it's a process. We'll figure it out. I'm not overly concerned, and just trying to stay disciplined. But it's really, I think kind of what we're chatting about right before we start recording is, it's really your side of the business is really driving the pricing, Paul, with a lot of the debt options and the bridge loans that are out there today.
And that's maybe the question that comes to mind that came in from Cecil in Albuquerque, New Mexico. We appreciate this question that comes from Cecil. And I think this is true for everybody. And we'll go back to being a bridesmaid in a second here. But Michael, why is it almost on every loan that's going to be required to buy a multifamily property? It's a bridge loan. So why is the only thing that's being offered out there bridge money?
Yeah, it's not the only things being offered, but certainly it's what is predominantly taking a larger share of new acquisitions. A lot of bridge loans, and we've done a couple of them here in the recent past as well. So we're part of the problem, I guess, too, participating in that. But I mean, yeah, you're seeing a lot of debt funds come out there and banks come out there and really realize that in 2020 they had all these loan goals and growth goals, and they basically sat on the sidelines the better part of the year. And they have kind of 2 years of loan production try to get done in 1 year, and they're all chasing the same deals. And so really industrial and multifamily are the darlings of the ball here lately. So there's only so many multifamily industrial deals to go around. So they're competing against each other, and really it's tightening spreads and lowering the cost of these deals and pushing leverage up. And you as a sponsor, if you can get higher leverage and lower pricing, that allows you to deliver better returns. So you're and then you're competing against other buyers that are kind of in that same loan pool. And then so what that's doing is just kind of really escalating pricing in real time. It's just kind of everyone's one-upping each other along the way. So it's really fueling price increases. And then you couple that with double-digit rent growth, and in Q2 pretty much across the country. In Q3 hasn't slowed down yet. It's really accelerating these pricing, which is where we're kind of becoming the bridesmaid here lately on a few deals. And so a lot of it's your fault, Paul, with all the different debt options out there. It's really fueling pricing, and that's kind of what I'm seeing from the operator in the marketplace.
I don't disagree with you on that. I mean, these bridge products, bridge loans, through these non-recourse debt funds that are being offered out there, they keep springing up like mushrooms in your backyard. That you want to see them every once in a while, but you don't want to see them all the time. And so, I think with one of the things that I have an issue with is a bridge fund really is a bunch of people getting together and saying, hey, listen, I'll extend my money out to be the lender in the deal. And then we're going to have a certain amount of rules, but there's going to be a quick maturity on this loan. This is not for 5, 10, 15 years. It's usually 3 years with 2 1-year extensions on that. So you got to execute your game plan fairly quickly to be able to either refinance the property or sell the property to the next person in the transaction. So is Fannie and Freddie, are they, you talked with Freddie recently. I mean, where are they at right now in the market? I mean, any concerns with them?
Yeah, I mean, I think I actually had a conversation yesterday as we record this with our guy at Freddie Mac, and we're just kind of talking about recently they expanded or gapped out, we'll call it the spreads they're charging on the loans, in an attempt to kind of slow down their inflows. And the feedback I got was they try to do about $1.5 billion a week in new loans they signed up across the nation company wide. And when the recent drop in late June, early July of 2021, you saw a recent drop in the treasury rates, but they held their spreads. It really allowed to get really good fixed rate pricing, and we actually took advantage of it. We're refinancing a deal, and we timed the bottom, and we're doing a 5-year full term IO loan. I think it's around 60 levered, a little lower levered, and we fixed the rate at 2.12, Paul, which is unbelievable. And
it's
so
a very unfair business to people like you that they do a lot of business with Freddie Mac versus the guys that just do a one-off deal. You're not going to get pricing like Michael gets.
Yeah, it was crazy, and we just timed the market perfect and hit it on the day of the lowest. And I've been on the opposite end of that, so it just felt good to time it. And now spreads are they widened their spreads quite a bit already, and the pay rates kind of where it was 2 months ago was the treasury's down, so they just basically widened their spread to kind of make the all-in rate where it was 2 months ago, and that's kind of slowing the business down intentionally for them. But one of the comments he said that internally they were seeing some deals come into the front door where they worked on today's low interest rates, but when they go to look at their exit tests and they were using a 3% rate, and can they refinance this thing in 7 or 10 years when the maturity was up at using just a 3% rate? A lot of these deals weren't sizing 7 or 10 years down the road. So they were asking themselves, should we be making loans to properties that can't exit at a 3% rate, 7 years down the road? And the answer that came in was, no, we shouldn't be doing that. So I think the agencies, basically my take are the agencies, Paul, are maintaining their discipline. And if we are getting a little frothy, is coming from the debt funds and the bridge market out there. And I mentioned we're doing some bridge loans, but the 2 bridge loans we're doing are bank loans, and we're getting really, really low spreads at 70 levered. We're not going to 80 or 85, and we're actually, as it gets my nature, but signing a little bit of recourse to get the spread down a little bit as well. So that's kind of the way we're approaching it, and just trying to lower the leverage a little bit, even if we're taking bridge debt, because I think that's a little bit more prudent. So we're taking advantage of the historically low spreads and rates, but without needing to pump the leverage all the way to 85%. And in our space, you can save probably a percentage point, somewhere between 1 and 1.5 percentage points on your interest rate, if you're willing to take a little bit of recourse and lower the leverage from, say 75 to 80 down to, 70%. I think that's kind of the trade that we're taking, and that makes economic sense to us in our business model and our business plan, Paul.
And folks that don't do a lot of bridge financing or haven't done a lot of bridge financing, or brand new people into the multifamily space, again, can you help me or explain to some folks of what some gotchas are, or things that people have got to be aware of when getting into these bridge loans? What have you seen that people should be aware of?
I mean, there's lots of stuff. So if you're willing to sign a little bit of recourse, the loan documents are pretty straightforward, because lender has a secondary repayment source, so you don't get a lot of noise in there. But you get these non-recourse loans where you sign kind of just the carve outs. One, they tend to be a little bit more expensive, like I talked about, and then two, within the loan documents, there's a whole lot of gotchas. So a lot of those lenders will require that you use a really expensive New York law firm, and so you're seeing six-figure legal bills on some of these from the lender side, plus your lawyer and securities lawyer, et cetera, in there. So the cost of these things should be pretty exorbitant, one. And then two, they make you have things like, lock boxes in place, or, spring-in lock boxes, or sweep accounts, or what are called DACA, deposit account control agreement. That's something that they'll put in there where they can, take your money if you trigger some sort of test within their system. So if you fall below a certain debt coverage ratio, that's the problem. They, typically escrow all your CapEx funds, and they could turn your lights out and not fund draws for pretty much any reason under the sun. So if, I heard a lot of people that got little pain points about a year ago when they were doing all this construction work pre-COVID, and then lockdown hit. Lender just said, I'm not funding any draws. So they started having to deal with mechanics liens from their vendors because they did this work but didn't have the money to pay them. There's just a bunch of million little different gotchas. The structure becomes a lot more complicated from a entity standpoint as well, where they make you have, all these different covenants and restrictions within your company agreement. And they make you get all these different various opinion letters from, it's a Delaware entity, and you got to have all these different Delaware opinion letters, and they're based out of New York. So New York enforceability opinion letters. And so every time you're turning around, it's adding, $5,000 or $10,000 and legal expenses that just, add up. And if it's a, $40-50 million loan, that's one thing. If it's a $15-20 million loan, those are much bigger on a percentage basis, because the cost of that stuff is pretty similar. So those are some of the things, and they can kind of punch your lights out at any time, Paul. So just go into those things eyes wide open, and make sure you have expectations of them being pretty darn expensive at the end of the day.
Punch your lights out. I like that. And again, we talked a little bit about some of the challenges that the bridge loan gives you, but what are some of the advantages? And again, the bridge loan is really not for the buyer, it's for the seller. So the seller can get the biggest price possible, that the buyer has the advantage of getting the bridge loan to get higher leverage, Michael?
Yeah, higher leverage. And then, if the property needs to be repositioned, it's not in a position today to go into, the gold standard, which is typically like your agency loan, or potentially maybe even like a life insurance company loan if it's a high quality deal. Then the bridge loan is for, a year or two or three to get the property from where it is today to a position where it can go into an agency loan, and that serves its purpose. But, just be going those with eyes wide open. I mean, we've done them, and it's a good tool to have in the toolbox. And, it's certainly, what I'm fearful is, a lot of these people that are, coming in the market are, driving pricing up, which is great, because the fundamentals are great. And so pricing needs to go up because we're collecting more and more income, month over month. But, at some point, if you're putting 85% leverage and you need everything to go exactly right and grow your rents to make your business model make sense, and your returns aren't, outsized. I mean, people are just financially engineering these deals and pushing the pricing up where they probably shouldn't be pushing the pricing up on some of these deals. But if they wouldn't push the price up, if that 80 to 85% debt fund wasn't out there offering, aggressive terms, which, reduces the amount of equity you need to put in the deal to juice the returns, but also exponentially increases the risk. So, trees don't grow to the sky. At some point, there'll be a softening or slowing. I mean, I think, over the next couple of years, I'm sure we're going to be fine, and the market's going to continue to grow and grow any potential problems. Well, you'll grow your way out of, but at some point the music will stop at some point. So making sure you have conservative, properly structured capital stacks with your debt and your equity, I think are of utmost importance and prudence, especially if you're a little bit newer in the industry and you don't know what you don't know.
Financially engineered. I like that phrase. So just be careful out there when you're taking a look and talk with folks, I guess, at Old Capital. But maybe you just want to replay this podcast again, listen to some of the nuggets of wisdom that Michael has spoken about, to just be aware of when you get into these discussions with your group to buy a property and how it's going to be financed and how where the equity is coming from. But definitely when you're listening to where the debt is, and can the debt come in and wipe out the equity in the future because you weren't able to execute your plan by refinancing the property in a timely basis, or by adding additional value to the property.
Yeah, the last thing I say, Paul, especially if you're like a passive investor, limited partner on these deals, and you're seeing two properties, two offerings from two different sponsors, and you're seeing one that is 85 levered or 80 to 85 levered, and have to grow rents a bunch and do a bunch of capital improvements to push the rents, and you're seeing something that's maybe more 70 to 75 levered, and you don't have to do a bunch of work, and the returns are pretty similar, but maybe the value adds 15% return and the more stable deals a 14% return. Just take into account, I think that's what is lost on a lot of investors that I talk to. Just doing this over the years and talking to, literally thousands of different people about apartment investing over the years. The concept of risk adjusted with the return, people to see the return, they don't maybe necessarily take into account all the extra risk they're taking into that business plan, and the market's going to continue to grow. So it probably covers up a lot of it, but that's going to work until it doesn't. So just, all deals from a risk profile aren't created equal. So those are some things I would take into consideration when you're comparing, one sponsored deals to the next.
Great information, Michael. If people want to know a little bit more about what SPI does, what does SPI do, Michael?
Yeah, really, the primary focus of SPI, Paul, is to put together high quality deals and go out and raise capital for them and syndication style. The other thing we do is we help high net worth individuals that typically are on a 1031 looking to come to Texas. They don't know anybody, know the market, and they want to kind of shortcut their expertise and rely upon, someone that's been in the marketplace. We'll do what we call kind of advisory services. So, if you have a chunk of change, typically 8-10 million and up is kind of anymore where the market's moved to, Paul. Used to be lower, but everything keeps going up. So to buy the type of deals that we want to do is probably closer to 10 million in equity. We can certainly kind of customize a solution for your problem or your need with your 1031. So if you want to talk to us a little bit more about either of those two things, the best way is simply to go to our company's website, which is www.spiadvisory.com. It's SPI like spy advisory.com. There's a contact us form. Fill that out, and we're always happy to send out a little bit more information about what we do. And if you haven't been to our website in a while, we just completely revamped the website, Paul. So it's not so crappy like it used to be. So you can actually find out a little bit more information than you used to be able to. So if you haven't been to our website in a while, go check it out. You see a list of our portfolio and have a little bit more information. And we updated our headshot, so I look a little bit older than I did last time on our website.
That's great. I haven't seen the website. Let me go into it and take a look at it like everybody else will. So again, Great information, Michael Becker. We certainly do appreciate it. I'm Paul Peebles. Have a great day.